So AI is set to revolutionize every aspect of our lives. Nvidia has been the big winner of this boom. The company has multiplied in value. Eventually, the venture capital was all spent. The companies collapsed and the infamous dot-com bubble burst. If you think a company will make much more money in the near future than it's making right now, then it could be a smart move to invest. It's now been 2 years since ChatGPT first released to the public. And although it's certainly gotten better, the progress hasn't exactly been mind-blowing. But investors who expect to see big things happening within the next few years might end up being bitterly disappointed. Unless you have had your head buried in the sand, you have probably noticed the huge investment boom that AI technology has been enjoying these past 2 years. However, warnings of an AI bubble have been growing, and many Wall Street analysts are now saying that the technology had been overhyped and that this will all end in disaster. Hello, I'm Khalid Shamim, a wealth manager who works with expats in the GCC, and today we are going to find out, is AI about to revolutionize the world? Or are AI stocks a bubble? And is that bubble about to burst? AI mania seems to be everywhere these days. Bill Gates, the co-founder of Microsoft, has even gone on record saying that the development of AI is as fundamental as the creation of microprocessor, the personal computer, the internet, and the mobile phone. It will change the way people work, learn, travel, get health card, and communicate with each other. Entire industries will reorient around it. Businesses will distinguish by how well they use it. So AI is set to revolutionize every aspect of our lives. And if businesses don't use it, they will be left behind by those that do. It's a small wonder that there has been a mad gold rush as everyone scrambles to invest in this incredible new technology. And as the biggest producer of the GPUs that are used in AI data centers, Nvidia has been the big winner of this boom. The company has multiplied in value in recent years to now reach a market cap of around $3 trillion, making it one of the most valuable companies in the world. And many other big tech companies like Microsoft and Meta have also used the AI boom to attract trillions of dollars of investors' money and hit staggering new all-time highs. But all these investors seems to have forgotten Warren Buffett's wisdom of be careful when others are greedy. Just like they have forgotten what happened to the over-eager investors in the last technology to revolutionize the world, the internet. Back in the late 90s, a huge speculative bubble had formed as investors poured money into internet-based companies. The internet was going to change the world. Everyone knew it. So it made sense to get in early and invest in anything that used the internet and looked vaguely promising. The only problem was that most of these internet startups could not generate enough profit to justify their inflated valuations. In fact, many of them couldn't generate any profit at all. Eventually, the venture capital was all spent. The companies collapsed and the infamous dot-com bubble burst, causing Nasdaq to fall by a massive 78% from its peak in March 2000. At the time, the dot-com crash took a lot of people by surprise, but with hindsight, it was incredibly obvious that there was a bubble. Let us look at one of the hardest hit companies by the crash, Cisco Systems. At the peak of the dot-com bubble, Cisco was the biggest company in the world, worth $555 billion. But this valuation was not justified by Cisco's revenue, which anyone could see by looking at their price to earning ratio. A price to earning ratio or PE ratio simply look at the company's price compared to their earnings. A typical PE ratio is around 20 to 30, which means typically a company worth is around 20 to 30 times what it makes per year. And if a company's PE ratio is much higher than this, it could be a sign that the stock is overvalued. What was Cisco's PE ratio in the year 2000? 196. In other words, overeager internet investors had pumped Cisco's price so much that it was around 10 times higher than the business's fundamental said it probably shouldn't be. Eventually, the fundamentals caught up with the hype train, and by 2002, Cisco's stock had crashed 88% in value, bringing Cisco's P ratio down to a much more reasonable 33. And now, overeager AI investors might be doing the exact same thing as what happened during the dot-com bubble. Nvidia's P ratio is now hovering around 70, which is pretty high, but is actually much more reasonable than their P ratio this time last year when it was a massive 247. And other AI tech companies have even higher P ratio than Nvidia, like ARM Holdings, a British company that designs AI chips, which has an incredible P ratio of 563. Now, to be clear, a high P ratio on its own does not mean that a company is definitely overvalued. If you think a company will make much more money in the near future than it's making right now, then it could be a smart move to invest. But what if that expected future revenue doesn't arrive anytime soon? Well, then this recent AI boom could turn very badly indeed for investors, and unfortunately, it's looking like the bubble might soon burst. Why? Well, there are three reasons. One, creating and running AI technology is extremely expensive. Two, advancement in AI technology comes much slower than people think. Three, the adoption rate and the demand for AI technology by businesses and consumers could be much lower than what people think. Let's take a look at each one briefly. Number one, generative AI is ridiculously expensive. Big tech companies like Microsoft and Google have had to invest tens of billions of dollars to build AI infrastructure and train their AI models. Not only that, but even once they have been built, then AI models require further billions to keep going. ChatGPT reportedly cost $700,000 a day to keep running because of the huge amount of processing power that is required for each query. And that's why the creators of ChatGPT, OpenAI, require financial backings from investors like Microsoft to stay afloat. Right now, it's hard to say when generative AI will be profitable. Reason number two, the AI bubble could burst soon. AI tech is not improving as fast as expected. It's now been 2 years since ChatGPT first released to the public, and although it's certainly gotten better, the progress hasn't exactly been mind-blowing. This is because in order to keep improving, AI large language models need to be trained on bigger and bigger data sets. Data sets that are basically made up of text that humans have written. But the problem is that AI companies have already used pretty much of all the text that is freely available on the internet, and they don't have any other way to get more. This might explain why the highly anticipated ChatGPT 4 took so long to come out, and why ChatGPT 5, which was originally supposed to be released this summer in 2024, has now been pushed back to 2025. OpenAI could be struggling to make the AI models significantly better than they already are. Now, this might be a surprise to some people who expect technology progress to be exponential. But history tells us that technology actually tends to develop in big leaps, and in between the big leaps, there are small, slower improvements. For example, look at when Apple released the first iPhone back in 2007. It was mind-blowing, a huge leap forward for mobile technology. But since then, each new iPhone has been less and less impressive. And now these days, there's basically no reason to get the latest iPhone other than bragging rights. The camera might be a little bit better, the processor might be slightly faster, but there's nothing revolutionary about the latest iPhone. And it could be the same story for AI technology. When ChatGPT first released, it was mind-blowing. But with each new model, the improvement have been slower and less impressive. And finally, the third reason that the AI bubble could soon burst, there simply aren't that many real-world applications for the technology yet. Many businesses are struggling to figure out how to use AI in its current state to increase profits. Some companies are using it to generate SEO articles for their website, but even that might have backfired as there's rumors of search engines penalizing AI written content. And because AI isn't yet reliable or trustworthy, it often requires a human to double check its work. In fact, Amazon got caught doing exactly that. A few years back, some Amazon fresh grocery store started implementing something called just walk out technology, where you could just walk in, grab whatever you wanted off the shelf, and then just walk out. You didn't have to go to a cashier to pay, because an AI would watch you through the cameras, figure out what you have taken, and automatically charge it to your cart. It was like something out of science fiction. It seemed almost too good to be true, and that's because it was. In reality, it wasn't just AI watching you. Amazon had hired thousands of humans to watch you too, because the AI was so unreliable. So instead of getting rid of cashiers, Amazon had actually just moved them somewhere you couldn't see them. Hardly the huge shopping revolution that had been promised. So there you have it. 3 reasons why AI might not change the world, or at least not anytime soon. Because don't get me wrong, I think there's definitely potential for AI to improve and do great things over the next few decades. But investors who expect to see big things happening within the next few years might end up being bitterly disappointed. After all, it happened with the internet. There was a huge investor pile on with the dot-com bubble. It burst, but now decades later, the internet really has changed the world. The same thing could happen eventually with AI. So, should you avoid AI stocks right now? Maybe, if you think it's a bubble that will burst soon. But then again, even if it is a bubble, then investor sentiment and momentum could mean AI stocks keep going up vertically for a while. It is impossible for anyone to predict with certainty what will happen, which is why I think the most important question in investing is risk management. In fact, if you want to keep one toe dipped in the stock market while keeping your risk low and your capital up to 100% protected, then there's a way you can do that. This is something that for decades was reserved for the world's ultra wealthy. But thanks to recent changes, regular retail investors like you and me can now take advantage of it too. If you would like to learn more, simply follow this link in the video description below. I have been your host Khalid Shamim, and thank you for watching this video. Subscribe if you have found it helpful, and I'll see you next time.